the size of these changes are not magnificent in themselves. They're not shattering in themselves. Let's set the stage first of all. A weaker than expected payrolls figure, a downgrade from Goldman Sachs on the growth outlook. Does it shake in any way the dollar narrative, which is leaning into, I would say, taper?
You know, I don't think it changes the dollar narrative because the dollar is in a sort of win-win situation. You get the interest rate differential argument if the Fed is tapering, if that debate about a Fed funds hike in 2022 is kept alive. But on the other hand, the dollar gains from safe haven. So it does benefit, but it does, I think, change the dialogue for many other assets. And this is the dialogue that it adds into this stagflation dialogue, the slowing growth dialogue. And that, I think, really does alter perhaps perceptions of where the world is going next year.
Well, let's just talk about stagflation, because there was a buddy of mine in one of the banks here, and he said, oh, but are you going to get 1970s stagflation, Minister? Are we going to get 1940s stagflation? Well, Jane, I was standing on a sand dune in the middle of the desert, and I didn't have time to debate the quality of stagflation. What kind of stagflation environment do you think we're going to get, and what is the biggest consequence in the FX world?
Well, you know, I don't think I'm going to compare it to the 70s. I think, you know, hopefully we're not going to be in that sort of situation. There's an awful lot of differences. But I think at the same time, we are potentially going to be in an environment where we see growth not as firm as perhaps we had anticipated for supply side reasons in many respects, but also this cost element, the fact that costs are coming through, that this could be a draw on consumers' pockets, on firms' pockets, and we're not going to get the demand. Now, this will be quite new because if we look at what's happening this year, it's been all about supply. Now, that still exists. We know that we've still got semiconductor shortages too. But on top of that, maybe we're not going to get the demand that we anticipated to. And I think perhaps the UK could be a shining example where you've got an awful lot of constraints coming at you with respect to demand.
Absolutely, and we're going to dig a little bit deeper into the UK in the next section. So I want to save my pounds, Jane. I want to save my pounds. I want to save my cable and my euro sterling. The potential slowdown. The dollar is the win-win. So there's, you know, you're looking at potentially a slowdown in China with inflation, a potential slower growth in the United States with a little bit of inflation. When it comes to those other big narrative, it is about energy and oil. We are in some kind of an energy redux crisis. I don't quite know what the right word is. Maybe you and your desk can help me define what it is. But more importantly, do you believe those commodity currencies rally can endure? The ruble, the CAD, the Colombian peso. Does oil and energy permeate the conversation that you're having for the FX narrative?
You know, it does. And I think this is particularly interesting when it comes to emerging markets, because all of those constraints that you've just listed, you know, a stronger dollar, a slower US, a slower China, higher energy costs, these are all significant constraints, particularly for EM. And yet the ones that perhaps are a little bit distinct from that are potentially EM that do have a energy export component. So those are the ones that stick out. What we're going to see, I think, is going into next year, a real distinction perhaps between the energy exporters and the energy importers, and also, you know, perhaps between even in G10. The Aussie is on the back foot, has been all year for a variety of reasons, but perhaps the liquid natural gas, the coal export potential does give it a little bit of a lift. So I think, you know, energy is really going to remain in the fore of our minds for quite a while, I think.